One of the toughest things that I've dealt with in my first 2 years of trading was trying to get a sense of when and where the best entries would be. Now, as I first began trading, and I haven't taken a lot of instruction from professionals or even seen that many instructional videos or taken that many courses, most of the stuff that I've learned, not all, but quite a bit of the stuff I've learned has been just through my own observation. So maybe that's bad because I haven't had anybody really to teach me personally about day trading, but I think using my own eyes is a pretty good way as long as I am taking lots of notes. So one of the things that has always bothered me was I just never knew. I knew that I liked trend continuation plays, and I knew that I liked to sell retracements against certain EMAs like the 8 and the 20 on faster time frame charts like 1 and 5 minute charts. But where exactly or which retracement like would be the best? Like some of them just don't go very far. On average they don't go very far at all typically. It's the rare one that really goes. And so I've never really known how to identify those, but I think I'm beginning to come up with an idea here that I want to run past you. The thing is you have to really start to look at those slower time frame charts to set up your entries for the faster time frames. And one of the things that I've been doing a lot in the last couple of weeks is looking at pivot points, areas in the chart where there's been a strong reaction after, say, a strong downtrend and then a strong reaction in the opposite direction. So this is a 4-hour chart on the Great British Pound Japanese Yen currency pair. And if you look at this carefully, you'll see that about a week ago on Thursday and Wednesday, Tuesday, Wednesday, and Thursday, there was a very strong push to the downside. And we went down, like 200 pips roughly in this time frame here. And if you'll look real carefully, I'm going to take this off for a second here. If you look real carefully here, you'll see this kind of an alternating bar pattern. I call this a Christmas tree, double bottom or double top pattern, because you've got alternating color bars there. So it did respond to this level here, and it did rocket back up here quite a bit. I don't really know the total retracement here. I guess I could take a quick measurement and figure it out. It looks like it came up, about 50%, which is pretty typical on the Fibonacci box there. About 50% retracement. Very, very typical. But I'm not really using the fib today. I just want to kind of get a sense of, let you know that this was a big retracement and a full 50% retracement of this move down. So what's key here is that this level gets marked. This level, and again, I'm marking the level of the bars, the bottom of the bars, not the wicks, but because they all kind of match up in that one spot right here, more or less, I'm going to go ahead and put a line there, a dotted line, and leave it there. And then what happens is the price is going to come back to it eventually. Well, eventually it does. And what happens when price comes back here? I mean, most people would look at this and say, well, that was a strong level of support. So if price breaks under there, go short, right? And that's showing weakness. So the way that people who haven't been trading that long, including myself, in a couple of years, it's not really that long at all. The way that people who've been trading not that long, typically when they're first starting out, how they handle that is they'll go to they'll see that on a slower time frame. That's great. They'll go to a faster time frame, like maybe a 1 minute, and they'll as soon as it breaks under, they'll try to go short, thinking, okay, we broke weakness. We broke support. We're going down. So let's say you get short here. Well, you're going to get stopped out right away. Or let's say you're a little bit more patient and you get short here. It doesn't go too far and it comes back up above again. And then the same thing happens here. So it's 3 times, 4 times in a row. Anybody who's trying to short beneath this level is probably going to get stopped out, or at least it's going to go back across their entry point, and they're going to have red stress. They're going to be in the negative, and they're either going to get stopped out or they're going to be sitting there in the negative unless they've got a very wide stop and they're patient. So how do you avoid all that? Well, I think the thing is okay, I found this on a 4-hour, right? So let's go back to let's go back to the slower time frames and let's take a look at a 1 hour on this area, okay? And let's start looking at a pattern that to me signifies a bearish move or a bullish move depending on the direction that it's going, okay? So here's the 1 hour for this, and as you'll see, here's the first break. Didn't go too far, right? Came back up. So we're looking at the second 1 hour candle that interacts with this level. And what you see there is you see a wick under and a body above, okay? Okay, we're starting to make some progress. So think of it this way. We're starting to make some progress. We wicked under it, and the body closed directly on the line. So that's bearish, but it's not bearish enough to go short yet. So looking at the next candle, evaluating the next candle, we wicked above and we closed below. So now, after 2 hours, okay, of interacting with this line, I feel like now it's ready. And why? Because you have a probe under, and then and I call that a fake out that draws traders in. You have a wick above, I call that a shakeout that shakes weak hands out. And then you have a close well below. That's a 1 hour chart based on a 4 hour pattern we observed on a 4 hour chart. Okay. Let me take another quick look at that again just to see it. Okay, it was right there on the 4 hour. And a few days went by, like a week went by basically. And then you have interaction here on the 1 hour chart with the fake out, the shakeout, and getting ready for the breakout. Okay, so now we're not quite ready yet. It's 1700 on Wednesday, December 13th. And what are we going to do next? Okay, so we're going to look on a 5-minute chart now for a pattern worth trading. Okay, so let's back this up real quick. Right about here. It is now 1700. Let's go to a 5-minute chart and let's see what we can see here. Okay, now if you'll notice at 1700, the end of the 1655 candle, because the 5-minute chart, we are still extended away from the EMA, and I want to see a retracement against the EMA before I get in. Why? Because you never want to buy when price is extended away. It's already moving down here, okay? In the last 20 minutes or so, it's moving away from the EMA. Wait, the best thing that you can do is wait for a retracement back to the EMA and then go. So let's see if we can get that. Now we're going to hate ourselves. Let's look at it on 1 minute. It's the same basis of EMAs, 5-minute EMAs. It's just that I've got this on a 1-minute chart now, okay? So it's a little bit more of a close-up. So the idea here is to wait for a retracement of the EMA and then get short, okay? So let's kind of see what happens here. Okay, kind of waiting here. Nothing's really happening yet. Oh, a little bit of a bounce here. Okay, get a little closer. Now, as you can see, it's sideways consolidating. That's typically the first step in a retracement and rejection and continuation. And it's retracing up towards it. Okay, it's touching the 5. It's looking for the 8. Okay, it's kind of hugging the 5. Okay, right now it's touching the 8, that level, right? And there's a red candle. Oh, okay. And you can see it made a solid touch against the 8. Look at that, to the penny. And now it's moving down. So maybe you wait 1 or 2 more candles just for full confirmation. Okay, there you go. That's all the confirmation I would need right there. Okay, I would be getting short right here. Okay. Stop above that level, maybe a little bit above that level. That's let's say 13 pip. Yes, let's go right there. Let's go 12. Let's go 12 pip stop right there. Check out the R to R on this. I happen to know that this goes down at least 7R. Look at that. So why did this trade work out so well? Why this trade and not all the other trades I'm always taking, like, when I'm not really looking at the larger time frames? Like, this is just so important, I think, to try to figure out why this trade, okay, worked out when all the other ones don't give me 7R or whatever this one ended up giving. I think that was about it right there. Yeah, okay, that it did. Okay, so that was 7.34R potential. Okay, I'm not saying I could have timed that, but if you know what you're doing and you're watching maybe a 5-minute chart, okay, you can see at the bottom this 5-minute dragonfly. It's kind of telling you, yeah, it's kind of done. This is kind of done. So basically at this point you've got, that's a 6.5. Okay, that's a 6.5R by the time this dragonfly doji shows up. Okay, so once again, it's so important. It bears repeating here. Why did that trade work out when most trades don't give 7R? It's because it was entered at a very specific place. And that specific place was you are breaking a pivot point that had a 50% retracement off a huge move down. Okay? So that pivot point was very pivotal area. Okay? Just not to try to be cute, and that's just basically what it was. Okay? So when price, and you're looking at the 1 hour again, that's a 4 hour. Okay, you can see it clearly on a 4 hour. When price broke through, okay, you waited a couple of hours, okay, in order to make sure that the pattern that it put in was a pattern that was sustainable to the downside. Sustainability is what you need. So you had your probe under, which kind of like is the fake out. You had your probe above, your wick above, which is the shakeout. And then you have your completion below. On the 1 hour chart, you switch to a 5 or even a 1, and you wait, okay, and that's at 1700 right there. And then you wait for the retracement to the 5-minute 8 EMA. You get it right here. You get your rejection right there on 5. There's a full 5-minute candle right there. And then boom, you are off to the races. Now, you want to trade it on a 1 and kind of get in at the first strong push. You know, you might save yourself a couple pips, which, you know, a couple of pips saved on the stop equals a lot more R units on the final risk return. It's amazing the difference of just a few pips can make in that R to R. So keep that in mind too. So yeah, basically you've got your touch up here and your rejection of the 5-minute EMA, and then you get your first really strong candle there, which is telling you, okay, this is ready to go. And you know, you can get in right here. In this case, it was a 12.5 point pip. If you are, let's say you're doing a $2,000 stop loss, you divide that by 12 pips. Divide that by the conversion for the British pound Japanese yen is 6.94, and you got a 24 lot right there. Okay, so if you're doing a $2,000 stop loss, and let's say you're using the 5-minute to gauge when the trade is done, and you look for something like this, like a dragonfly doji, that's going to give you a six point. That's a $12,000 trade right there. And I mean, you can go to FTMO and get a $200,000 account for $1,200. A $200,000 account for $1,200. You're only risking 1%, and you just made, you know, 6R. So you made, you know, $12,000. You know, that's, you're more than halfway to your target for phase 1. So that's just something to keep in mind, guys. I hope that this makes sense. And if you have any questions about this, feel free to shoot me a message.